Hey, what's up, my friend? So in today's episode, I want to share with you how do you combine, right, trading indicators like a pro. Because here's the thing, right? I see many new traders when they get started in trading, one of the first few things they look for is indicators, Rayner indicators, moving average, MACD, RSI, and they wait for all these indicators, right, for all their signals to align, right? Thinking that, the more the indicators align, the higher the probability of the trading setup, right? But that couldn't be further from the truth, right? So why is that? Well, I'll explain more in today's episode, right? But first, right, before you get started in indicators, right, you must understand one thing. You must understand, right, what indicators can be used for, right? Indicators, there are many out there, but you have to ask yourself this question: what are those indicators built for? What are they used for? So based on my trading experience, right, most indicators, right, can be used for one of these four categories. Okay, the first category is indicators can help you identify market condition, right? Whether the market is in a range, whether it's trending, whether it's in a low volatility environment, etc. Number two, indicators can help you better time your entry, or rather, indicators can serve as an entry trigger, right? Telling you that, now is the time to enter a trade, provided, right, the other market conditions are met, okay? Number three, indicators, right, can also help you, or rather, to signal to you, right, when to exit a trade, especially whether, you want to be riding a trend or whether you want to capture a swing in the markets. Indicators can also serve that purpose. And the fourth category is this, right? Indicators can help you identify areas of value on your chart, especially when the market is trending, right? For example, in a healthy trend, I would say the 50-period moving average. It's a very useful tool, right, to identify area of value, right, in this type of trending, healthy trend market. Okay, so these are the four main categories, right, of what indicators can be used for, and you must understand this, okay? So once you understand this, right, then the second thing, right, that you want to move on to is to understand the purpose of your indicators. So yes, most indicators, right, can serve one of those four purposes, but some indicators can serve all of these four purposes, and some of these indicators can only meet one of these or two of these purposes. So let me explain. So for example, Fibonacci extension, right, it's an indicator to me, right, it's an indicator that can be used, right, to help you exit your trade, especially in trending market when the market, is on this trending move up higher, right? When it's a trend consists of a series of higher highs and higher lows, right? It goes up, comes down, goes up, comes down, goes up. So when you are trading with this trend and as the market is going up, right, you might want to exit your trade before it makes a pullback. But we know where at what point in time, right, or which point of reference do you use, right, to know when to exit before the pullback occurs. So this is where the Fibonacci extension tool can be useful. You can use the 127 extension or the 138 extension, right, to help you to signal to you, right, when to exit your trade, right? So this is how a Fibonacci extension tool is useful. On the other hand, you can use a tool like the average true range indicator. That indicator serves multiple purposes. Number one, it can help you define the volatility of the market, whether volatility of the market is historically, is it high or low right now. Number two, using that volatility of the market information, you can use, right, that figure to help you set better stop loss. You can even use it to trail your stop loss, right, in a trending market. That's possible as well. So you can see that the ATR indicator serves multiple purposes. And finally, a moving average. This indicator is even more versatile. It can help you, or rather, it can meet all four of your categories that I've shared earlier. Number one, moving average can help you identify the market condition, whether is it trending or range. Number two, moving average can help you act as an area of value, as what I've shared earlier, right? Using the 50-period moving average in a healthy trade. Number three, moving average can help you serve as an exit, right? Basically, you can use it to trail your stop loss, right? With the hopes of riding a trend. Okay. As for entry trigger, moving average can be like something like a moving average crossover can also serve as an entry trigger. So you can see, right, that you must understand the purpose of your indicators and see where it fits among the four categories. Some indicators meet only one or two categories. Some indicators, like the moving average, can fulfill all four categories. So it pays to understand, right, the purpose of your indicators. Moving on, number three. Before you use any indicators, you have to know what you need. What do you need out of your indicators, right? Because some of you might be a price action trader and then using indicators to kind of like supplement your trading. For example, you read the charts using the naked price action, just naked chart to identify the current market condition. But you can use indicators to maybe, let's say, help you manage your trade, to know where to set a proper stop loss, or rather to know how to trail your stop loss with the hopes of riding a trend. So you have to know what you need in the first place, right? What do you want out of your indicators? Because if you do not know what you want out of your indicators, then it's going to be a complete mess. You just pick everything and anything that comes your way, and your trading is hopeless. Okay. And the fourth and final thing that I want to share with you, right? The fourth and final tip is this: is that you only want to use one indicator from one category. So what do I mean by this? So for example, let's say you are using moving average, for example, right? You want to use it to manage your trades, to exit your trade, to use it to trail your stop loss. Then that's fine. You can use moving average, but don't use moving average. Don't use the chandelier crow stop. Don't use all these other fancy indicators, right, to help you manage your trade, because this is where you're going to get conflicting signals. Okay, so just one indicator from one category. If you want to use an indicator to, for example, help you to act as an entry trigger to enter your trade, then just use one indicator. Maybe, RSI crossing above 30, that's the indicator. Great. Don't use the RSI, don't use the stochastic, don't use all so many indicators to time your entry, because again, right, if you have too many indicators for one category, you will get conflicting signal. Okay, so pay attention to that as well. Okay, so a quick recap, right, for today's episode. Number one, know the categories, right, or rather the functions of what trading indicators can be used for. It can help you, define market condition, identify area of value, serve as an entry trigger, exit your trade events. Okay. Number two, know the types of indicator, know the purposes of your indicators out there. This, means that you have to really understand, what this indicator is about, how it works and stuff like that. Number three, know what you need. Okay. Do you need help with, defining the trend? Do you need help with, entering your trade? So know what you need and then find the appropriate trading indicators for it. And finally, number four, not more than one trading indicator from each category. If not, you will get conflicting signals and you will be confused. All right. So with that said, I've come to the end of today's episode. I will talk to you soon.